Hello, this is Dean Malone with Compass FX. I hope you're doing well today and you're getting some good trades. Today I want to continue in my series on keeping your trading simple. Too many times traders get wrapped up in these advanced strategies, these advanced concepts, thinking they need to put more and more on the chart to get some pips out in the marketplace. When really, in many cases, some of the most basic, simple processes that you go through or methods that you may go through will yield plenty of pips out of the market. Today I want to specifically talk about avoiding trades. Oftentimes traders get so wrapped up, or they look at a chart and they think, I need to get in the market right now, but they don't wait for a proper setup. And sometimes stepping into the market isn't really the right thing to do. So today I want to show you a simple technique to help you avoid stepping in the market when you may not want to. Now, what do I mean by that? Oftentimes the market may kind of move up and down in a slight channel or slight sideways area that really isn't showing direction one way or the other. Well, how do you know that? Well, if you put a trending channel on your chart, you can often find, maybe in a little bit larger time frame, that the market's moving sideways inside that channel. Well, years ago I developed the synergy trading method. And one of the tools I developed was what's called a price action channel. And what you see on the chart right here is two yellow lines. These yellow lines provide that trend channel for me. And let's keep this concept pretty simple. Whenever the market is trending below the channel, and in this case you can see all these red bars below the channel, we have a downtrend or a looking to go short the market. However, when the market pulled up right here and went inside the trend channel, and notice how the trend channel went sideways, it really wasn't showing an up or down direction, then there's no trading going on. You're not supposed to pull the trigger right here. The market is basically pulling back, and the reason for it pulling back is not that traders are going long, is that the traders are taking profits on their shorts. So when they cover their shorts, taking profits from their shorts, they have to go long into the marketplace. So some traders look at this and they think, well, now's time to go long, but then the market rolls back over, goes short again, and goes flat, drops a little bit, but then eventually back into the channel. Now I call this the price action channel. It's made up of two moving averages. It's the 5 smooth moving average set to high and set to low. One key thing here is the time frame. I often look at a 4-hour chart as being the big time frame for an intraday trader. So on a euro-dollar 4-hour chart, we can see today, as I was trading, that the market was really inside the channel. It went above the channel when it broke above 32 and went up to about 32.20 area and then fell back over. Now, can you trade this? Yes, you can if you're looking at possibly the smaller time frame. If I step down to a 1-hour chart, you can see that we broke below, but inside the channel we wouldn't trade in this area. We're looking for the price to break below the trending channel, I refer to as a price action channel, and trade in that direction. Then when the market pulls back in the channel, there's no trading. Keep your trading simple. Know when to pull the trigger, know when not to pull the trigger. So when the market pulls back up and you're thinking, well, there's a possible double bottom here maybe, then maybe I should be going long. Well, if you look at a little bit longer term picture and see that it's inside the price action channel, there's no trading going on. As a matter of fact, in this case, look at the Traders Dynamic Index. You can see the green over the red rising, but it's below the yellow market baseline. There's no trading here. The current sentiment in the market is going opposite the direction of the overall market sentiment. It's slightly downward in the market baseline. Let's go take a look at a couple other charts and let me show you what I'm talking about this in a little bit more detail. When you look at the pound dollar on a 4-hour chart, today I did not trade the pound dollar because when I looked at the 4-hour chart, we're pretty much inside the price action channel. And what I'm looking at is the body of the candle, not necessarily the wicks of the candle, but you can see the market pushed up a little bit and faded back down. Pushed up a little bit, faded back down. Then it dropped inside this. So Literally today, as I was watching this take place, I noticed a couple of things. One, we're trying to break outside the channel, and the other thing is that the overall trend direction is down. So really, should I be trading this? You can see that the Trader's Dynamic Index was showing an upward move, but price really wasn't going there. So you got to be cognizant of divergence that goes on in the marketplace. The market's kind of flat here based upon price action, but the Trader's Dynamic Index is trying to push up. So we have Trader's Dynamic Index showing upward sentiment with price being flat. That's a divergent move, and we probably would look for the pound dollar to drop down lower. Taking a look at the pound yen, again on a 4-hour chart, I happen to find that the 4-hour chart does the best at showing when price action is inside the price action channel. You can see here, look at all of this. All of this is inside the price action channel. Now you may be thinking to yourself, well, could I have traded that short? Yes, you could have if you step down to a smaller time frame. But based upon the 4-hour that we see here, the body of the candles pretty much stayed inside. Now we had one push down in the European session. The market pushed down, came back inside the channel. You can step down, like I said earlier, to a 1-hour and try to catch these on a smaller time frame. But I wouldn't go any lower than a 1-hour. Keep it at a 4-hour or 1-hour. You can see in the dollar CAD very clearly how the market had pushed up above the channel. And this is what I like about this technique, is that when we're inside the channel, no trading. When we break outside the channel and close outside the channel, then you're trading. That's what you're doing. And you can see how the market pulled down. We're not going short here. Let the market pull back. It holds. At this point, when the market starts making a move back above the price action channel, we're now going long. Market pulls back into the channel, no trading. Pushes above the channel, closes above the channel, now you're trading. Steps back across the channel, inside, no trading. It comes below, closes below the price action channel, even though it shows a swing low right here. The market faded that, and then it dropped on the dollar CAD. We've had some nice movement down in the dollar CAD, and the reason for that is a lot of dollar bulls in the marketplace going into month end decided to take some profits because we've seen some upward movement in the dollar CAD. So as I've been talking about, you can use the 4-hour is my preferable way of looking at when not to trade, when it's inside the price action channel, but you can also see this on a 1-hour chart. You can see pretty clearly there was no trading here, then the market pushed up. Then the market fell back in. No trading. Market pushed up again, so we're going long. Fell back into the channel. Look how clean this look is right here. There's no trading. Then the market pushed up one more time, came back to the channel, bounced off the channel, and went up one last bit. So we literally had a 1, 2, 3 move up. The market went flat, and look, most of the day the Aussie dollar stayed right inside the price action channel. I did no trading today on the Aussie dollar. So again, long story short, find the trending channel. Whenever the market's above the trending channel, trade long. Whenever the market's below the trending channel, then trade short. If it's inside that channel, avoid trading. We want to keep our trading simple, and we want clear signals as to where the market is moving to. The market's going to move up, it's going to move down, or it's going to go sideways. If it's moving up, we're trading long. Moving down, we're trading short. If it's moving sideways, avoid trading. Don't step in the market. Move on to another currency pair. I hope some of this information I've shared today will help you in your trading. This is Dean Malone with Compass FX. Y'all make it a great day. Get some good trades. We'll talk to you next time. Take care. Bye-bye.